Answer this question. Why does the price move up or down? Time's up. The answer is simple. It's all about supply and demand. When supply becomes greater than demand, the price falls. But when demand exceeds supply, the price rises. That's the foundation of every price movement you see on a chart. So, as a trader, if you can spot moments when the balance between supply and demand shifts, you'll have a strong understanding of how price might move next. That imbalance gives clues about future price action. Now, how do you identify supply and demand on a chart? There are two main ways: through price action analysis or through indicators. Price action remains the most powerful method since it shows you patterns directly on the chart, but indicators can also help visualize these key zones automatically, which makes them easier to use, especially for beginners. Let's walk through 3 helpful supply and demand indicators available on TradeSnipe and explore how they work. First indicator, supply and demand zones. Go to your indicators, search for supply and demand zones, and select the tool. Once added, you'll see certain areas on the chart highlighted as supply or demand zones. A supply zone marks where significant selling pressure appeared, pushing the price down afterward. A demand zone shows where buying pressure dominated, driving the price higher. This indicator detects such areas based on the following logic. A supply zone forms when there are 3 or more consecutive bearish candles with above-average volume. It then looks several candles back to identify the last bullish move before the drop, using that candle and ATR calculations to draw the zone. A demand zone works the same way, but in reverse, identifying clusters of bullish candles followed by a look back to the previous bearish candle. Each zone displays bullish or bearish volume, helping traders estimate the strength of those levels. The higher the volume, the stronger the possible imbalance. When a price retests a zone, it's shown by a dashed line. If it breaks and moves beyond it, the zone is removed, keeping your chart clean. Supply zones act as resistance, while demand zones function as support. Both are crucial for planning entries, stop losses, and profit targets. Second indicator, dynamic supply and demand zones. Next, search for dynamic supply and demand zones. Once added, this indicator shows levels with a built-in volume profile. Under its settings, enable dynamic lookback, so the indicator adjusts automatically to market changes. It works by using pivot highs, pivot lows, and volume data to identify significant zones and measure their relative strength. Red zones usually represent supply, while green zones represent demand. Each zone often comes with a probability label. For example, a supply zone at 91% and a demand zone at 94%. These percentages suggest how reliably that level might influence price action based on market structure and volume balance. Unlike the first indicator that reacts to short-term fluctuations, this one focuses on broader, stronger levels that could serve as future support or resistance zones. Third indicator, multi-time frame supply and demand zones. Finally, search for multi-time frame supply and demand zones. Add it to your chart, then open its settings. Here, select multiple time frames. One should match your current chart and the other should be higher. For instance, if your chart is on the 1-hour time frame, you can set the higher one to 4 hours. The chart will now show both sets of levels labeled differently, e.g., 1H for current, 4H for higher. The higher the time frame, the more significant the zone. If a 1-hour level overlaps with a 4-hour zone, that area becomes especially important as it represents strong agreement between buyers or sellers across different scales. Multi-time frame analysis helps traders align short-term entries with long-term market structure, and this indicator allows you to do that without constantly switching charts. In this tutorial, we explored 3 powerful supply and demand indicators on TradeSnipe that help identify key support and resistance zones. Understanding these concepts allows traders to make smarter entry, stop loss, and profit decisions, all based on market imbalance, not guesswork. That's all for this session. Thanks for watching, and keep learning more about how supply and demand truly shape price action.